Welcome, future CMAs, to this explainer. I am so incredibly excited you're here. As your teacher, I'm going to guide you way past that basic, entry-level idea that price times quantity simply equals sales. Because, look, for any business, revenue is the top line for a really crucial reason. If a company doesn't get its revenue analysis exactly right, well, literally every single profitability metric below it becomes incredibly misleading. So today, we're going to unlock exactly how to analyze it the right way.
We've got to kick things off with a pretty fundamental question. Is revenue growth always a good thing? Because for the CMA exam, a simple top-line sales bump just isn't the whole story. When most people hear revenue analysis, they think a 10% jump in sales is an absolute automatic win. Oh, if only the exam were that basic, right? The ICMA really wants to know if you can look past that simple growth to truly analyze what is actually driving those numbers.
Okay, so here's our roadmap for this explainer. We're going to cover the big picture, the sales variance framework, quality of revenue, a practice problem breakdown, and finally, those essential exam traps. It's systematically designed to dial down your exam anxiety and build up your analytical foundation, step by step.
Let's dive right into our first part, the big picture, moving beyond the top line. As strategic financial leaders, we really have to peel back the layers to answer 3 strategic questions every single time we evaluate a revenue figure. We can't just stand up and applaud a $10 million revenue jump. We have to ask the tough questions. Number 1, is this growth driven by higher prices or is it just higher volume? 2, how do changes in the product mix actually impact our overall sales revenue? And, vitally, number 3, is the quality and sustainability of this revenue stream high or is it kind of fragile? These are the exact layers you're expected to uncover. All right, moving right along to the sales variance framework, where we start breaking down those deviations. This brilliantly illustrates how total deviation splits right down the middle. Basically, when total revenue deviates from your budget, it breaks into 2 main components. First, you've got the sales price variance, right? Did we sell at higher or lower prices than we planned? And second, the sales volume variance. Did we sell more or fewer units than planned? Now, since almost every real-world company out there sells multiple products, that volume variance actually breaks down even further. It splits into a sales mix variance, meaning, hey, did customers buy our high-margin luxury items or our low-margin budget items? And a sales quantity variance, which just tells us if overall market volume moved up or down. Now, you are absolutely going to need to memorize this clean breakdown of formulas for exam day. For sales price variance, we take the actual quantity sold and multiply it by the difference between actual price and budgeted price. For sales volume variance, we take the difference between actual quantity and budgeted quantity and multiply that by the budgeted price. As your teacher, I'm telling you, pay special attention to exactly where actual quantity and budgeted price are used in these formulas. That is literally where so many candidates slip up.
So the crucial point to grab here is a quick pro tip that's going to save you so much time and stress during the exam. Always, always align a higher selling price with a favorable variance, represented by an F. Make sense? Conversely, a drop in sales volume will yield an unfavorable variance, represented by a U. Definitely lock that into your memory for test day.
Next up, let's talk about the quality of revenue and finding those hidden red flags. Now, here is a massive red flag you always need to watch out for. High-quality revenue is sustainable, repeatable, and most importantly, it's backed by cash flow. If revenue grows just a little bit, say 5%, but suddenly your accounts receivable spikes by 35%, you need to flag that immediately. This huge discrepancy is often a glaring signal that the company has loose credit policies, maybe some aggressive revenue recognition, or simply put, customers who might not be paying. To check if revenue quality is deteriorating because of those loose credit terms or aggressive recognition, you're going to need to calculate days sales outstanding, or DSO. The formula is simply accounts receivable divided by total credit sales multiplied by 365. Now, think about it. If this number is stretching out significantly over time, that cash isn't coming in the door, and the true quality of that revenue is dropping fast. Whenever you're analyzing financial statements for an essay question, I want you to keep your eyes peeled for 3 specific red flags. First, like we just talked about, accounts receivable outpacing revenue growth. Second is customer concentration risk. I mean, if 60% of total revenue is tied to just a single buyer, that revenue carries immense volatility risk. And third, channel stuffing and heavy fourth-quarter discounts. Companies will sometimes stuff the distribution channel at the very end of the year and offer massive discounts just to hit their quarterly bonuses. They're essentially borrowing future revenue to look good today, and the ICMA will absolutely test you on that.
All right, let's get into our practice problem breakdown and start applying the math. Grab your scratch paper because I want us to walk through a classic CMA Part 2 multiple choice scenario together.
Okay, so here are our scenario parameters for a fictional company called Apex Tech. Let's say they originally budgeted to sell 10,000 units of software at $100 per unit. But at the end of the year, they actually sold 12,000 units at a price of $90 per unit. So they definitely sold more units, but at a noticeably cheaper price than they planned for. Let's find those variances. Let's break this whole thing down together, step by step, using the formulas we talked about. Step 1, the sales price variance. We take the actual units sold, which is 12,000, and multiply it by the actual price minus the budgeted price. That's $90 minus 100, which gives us a negative $10. Multiply that negative 10 by 12,000, and you get $120,000 unfavorable. Easy enough, right? Step 2, the sales volume variance. Take the actual units of 12,000 minus the budgeted 10,000 units, giving us a positive 2,000 unit difference. Multiply that by the budgeted price of $100, and we get $200,000 favorable. Finally, step 3, we combine them. A $200,000 favorable volume variance minus $120,000 unfavorable price variance leaves a net total variance of $80,000 favorable. Now, here is the massive strategic takeaway for your essays. While they made $80,000 more overall, they slashed prices by 10% just to push 20% more volume, which means their gross margin percentage likely dropped significantly because their unit costs probably didn't go down.
Finally, let's talk about essential exam traps and how to safeguard your score. Listen, I am so incredibly proud of the effort you're putting into your studies. So here is my ultimate warning to you as your teacher. Never, ever evaluate price variance using budgeted quantity. Let me say it again. Always multiply the price difference by the actual units sold. Test makers absolutely love to slip the budgeted quantity into the multiple choice options just to trick you. Do not fall for it.
I highly recommend you jot down these 3 golden rules right now. Rule number 1. As we literally just said, always use actual units sold for price variance. Rule number 2. Link your revenue analysis directly to working capital. Remember that sudden volume spikes require way more operational cash, more inventory, and heavily impact accounts receivable. And rule number 3. Look out for non-recurring revenue items. Things like one-time license fees, selling an asset and misclassifying it, or wild foreign currency gains can completely distort the real revenue trends.
You know, any student out there can simply read a line item on an income statement. But as future CMAs, I want to leave you with this question to really remind you of your true strategic role. Are you reading the story behind the numbers? Keep practicing those variance calculations, keep reviewing those quality indicators, and keep building your confidence step by step. Work through a few practice questions today while this is still fresh in your mind. You have absolutely got this.